What I want to do is really just give you a quick flavour of the waste industry. I'm here masquerading as a chairman. Well, I am the chairman of Waste2Tricity, but I do an awful lot of other things. I'm in the process of raising probably about $2 million for one of our community investment projects for an AD plant, which will be community owned in our village. So the point I first would make is that, of course, although you can be here today and you're thinking around technology, investing in technology, this is about these three horsemen of the apocalypse, or the three musketeers, depending on whether you're buying or selling. It's about economics, it's about technology, and it's about the public understanding, if you like, the social glue, the planning system, compliance and acceptance that actually delivers projects. It's no good just having the technology. And of all these three, then the technology one, in my mind, is actually lowest on the agenda at the moment. It's one where it's not exactly invented, we are a long way down the road. And one of the key issues that certainly has been impacting my life over the last 25 years, when I happen to have been stuck in the waste industry because it's great fun, is the big shift in the dynamic of the sector. A shift that's largely gone unnoticed, I think, by government. This is an industry that's showing, even conservatively, 8% compound growth in gross value added. We'll come to the money in a moment, but you can see from these tonnage comparators that there are radical shifts taking place, all really driven not so much by regulation, but more by the landfill tax, which has taken gate fees from a £7 level in the 1997 period to around £100–105 a tonne now. And so you've seen the resurgence of these massive new industries, some of which, like MRFs, or material reclamation facilities, simply didn't exist 15 years ago. If you then take that to just looking at the carbon organics, this doesn't include the ferrous scrap industry or the inorganics that are associated with aggregates. Again, you've seen gross sector value added on a like-for-like basis going from 3 billion approximately to 8.5–9 billion. There is another 3 billion in this industry, but it's associated with downstream processing once material is recycled or composted or incinerated and so on. So I've not included that, but most people, if you throw in the water industry, you're looking at a sector, or the dirty water industry and the sewerage end of it, you're looking at a sector with a gross value added of around 15–18 billion pounds a year. I gave evidence a couple of weeks ago to the Lord Select Committee on biomass in the UK economy. If anybody's interested in that and understanding the dynamic a bit more, then do let me know and give me your card. The great thing, of course, about the industry is that you've got these gateways. Once you've collected material, you've got all these different technology exit routes, and the exit route is decided partly by the cost of segregating material to a standard that gets it to be able to be processed cost effectively through those technologies, but also the actual gate fees needed. Generally, as you go up the investment cost curve, then the energetic efficiency of the conversion process increases as well. But where we are at the moment, of course, is that we're in the sort of lower ground of anaerobic digesters, poor efficient conversion systems, and in some cases relatively high emitters of carbon dioxide. But they are cheaper and more cost effective than the sort of things that I'm involved with in Waste2Tricity. And these are the shifts that are taking place. Tax push, we're going from a gate fee type environment where, as the global middle classes expand, the cost of resources is going up, and therefore you're seeing challenges around the cost of raw material inputs, and also you've got this ripple out in the context of the so-called looming electricity, and possibly, depending on the Ukraine, the wider energy market if you include gas. So an interesting sector, and there are 4 investor requirements that we picked up, certainly not just in Waste2Tricity, but across the piece, and that's this obsession, and I know that this occupies the GIB, this obsession to secure feedstock contracts. Secondly, the issues around intermediate quality control, because it's no good having a technology that requires pre-sorting or a particular grade of input feedstock if in fact you don't control the upstream logistics and waste separation process. The other impact is that if you're actually going down an energy route, then it may be that your efforts to secure those feedstocks are disturbed by what might be happening in the price for recyclate plastic or wood or whatever, and indeed what happens with co-firing and wood co-firing plants and all that goes with the market regime. We have no luck with banks. I don't think banks are interested in this sector. It's too risky. They don't understand it. Venture capitalists, I've been an advisor to a number of major VC funds, and I gave evidence alongside the Web Partnership. The whole issue of that was looking at the reasons why there's no investment appetite to go into this sector at the moment. And a lot of it, of course, is around the uncertainties of government policy around ROCs and FITs and subsidies, basically, in the energy space. High net worths are good initiators in this process, and indeed I put money into a number of projects myself, often on a regionally based system, and of course we made a great play at their Lords Committee that it's important that those high net worths do get tax breaks if they put the money up front. We're seeing now, with the spread of corporate social responsibility, a growing interest in completing or closed-loop collection systems for waste, whereby the large corporates are themselves now looking to take ownership of their material 3 or 4 years after they've sold it. That's in its early days, but certainly in the waste electronics sector, that's been happening. As far as Waste2Tricity is concerned, we really originated we are still a facilitator. There are only 2 full-time employees. Depending on the funds, I either get paid or I work pro bono. But my contact base enables me to link the funding, the waste sources and the contacts in the waste sector, but our initial investment came originally from a hydrogen fuel cell company that's probably furthest down this road. They're a 20% stockholder. They were 100%, but they gradually diluted their share. And Advanced Fuel Cells, AFC, are working with plastic-based. They're fully funded. They don't have any issues. They're not raising capital at the moment. That's chaired by Tim Yo. They operate down in Guildford. And we've got hydrogen fuel cells now that will be, the idea is that these are placed into 40-foot ISO boxes. So instead of being connected to the grid, you have a removable fuel cell, or a hydrogen truck comes, puts hydrogen in one end, and you get electricity out of the other. They were basically interested in integrating up the supply chain to produce the hydrogen. So we did, we surveyed the energy market for advanced high-temperature plasma gasification systems and came up with Alter-NRG, a Canadian-American concern, part owned by one of the largest energy suppliers in Canada. And we've got the license deal for the UK and for countries in the Far East. And as a result of that, we actually gained royalties by marketing the technology to a number of potential interested major blue chips in the UK. One of those, in fact, is now likely to be commissioning their first plant. I've got some pictures of it. It's a £300 million investment being undertaken by Air Products, who have a history in the waste incineration industry in New York and the Northeast, well, across the US. They got out of that business for a variety of reasons. Waste in the States is an interesting market, to say the least. It's even more interesting than the UK. But we are now looking at sites in the UK for this technology in our own right. Our business model is basically SPVs. We're working with top dollar engineering companies, Foster Wheeler, who we're looking to provide the technical wrappers on and so on. So, it's a complete, although we're technically just a two-horse company with a board of directors, we are basically a facilitator, and we leverage into major potential blue chip investors with substantial balance sheets. The other mantra that I repeat is that if you're going to do anything in the waste space, you have to co-locate your conversion system as close to the energy sink as possible. And once you define I did some work when we sold Biffa for a very useful price actually, but we sold Biffa in 2008. I did some work for Advantage West Midlands with a number of interested parties, and we came up with a system for following this discipline. So you start looking for the sinks for electricity, for heat, combined heat and power, and you then vet those locations as to their suitability to co-locate a conversion process. And the heat sink defines the energy profile, and the energy profile then drives the technology. You see so many cases at the moment of plants being located completely irrationally, distant from motorways, or either away from a waste source or not close to the energy output. And these are the sorts of locations that we surveyed, and they're on our shopping list. In some cases, from my days at Biffa, for instance, I was at one stage a director of Adgen, which is now Tamar Energy. They took our advice, and Sainsbury's are now putting in a wide range of AD plants across the UK, right alongside their big energy sinks, their freezer centres, RDCs and so on. But these are the sorts of places that you ought to be looking to put new technologies. Our kit is, that is a big ship. That's just crossed the, well, it's actually came over from the Far East where the unit was made. That's the board process. The thing on the ship was that retort vessel. It's basically like a plasma arc in an electric arc furnace. These things come off the stocks at about $500 million. It's very expensive. You're looking at £750,000 per processed K-ton going through the plant, but the idea is that you convert at high temperature, you end up with a clean syngas, and instead of having to go through the steam phase and the turbine, you go straight to gas turbine because there are no tars, no pollutants, and your efficiency level goes up by a factor of as much as 30%. And it also offers, through that syngas, the option to distill the outputs into different streams. I'm moving through these very quickly. They'll just give you an idea of what the plant looks like. In parallel, of course, the most efficient way once you've got to a syngas is really not to take it down the electricity route at all. You're far better off injecting it to gas to grid, and that widens our range of potential investors in terms of the gas supply companies in certain circumstances. And certainly hydrogen, I know it's been on the agenda, it was in the agenda even when, you know, I know that somebody that graduated in 1969 is more or less, you know, not that, he's closer to Richard III probably than he is to the present, but in my case, hydrogen was still being talked about as the Wunderfuel in the 50s, so some cynics might say we're no closer, but I'll be able to tell you a bit more about that in the, at the end of this year when we see how Air Products are getting on with their commissioning. The lights are probably going to go out in my book. We've got a government that actually has undertaken a process called the EMR, the Energy Market Review. For about the first 6 months or so, the Secretary of State didn't understand the difference between electricity and energy. He didn't do much about the market, and as for reform, well, dream on. The fact is, I think we've lost a major opportunity. We've got a lot of political short thinking here, largely because it was the current process was influenced by certain members of government who were then involved in electricity privatisation as private consultants. So they're finding it rather difficult to separate themselves from this beast that they created. But what we've got, and I call it Old MacDonald's Farm, is here a rock, there a rock, everywhere a rock rock. We've got 30 technocentric subsidies in this industry. It's crippling investment appetite. It's introducing risk. Nobody believes the government when they say, yes, we're going to keep you paying these rocks to you for FITs or CFDs, who knows, contracts for difference. Nobody has any confidence that these things are still going to be around in 5, 6 or 7 years. And we're currently, of course, in the midst of a big storm about how poverty is impacting this process. So there are 3 simple things you've got to do if you're investing in this sector. You've got to maximise the energetic conversion efficiency of the technology. If you get 1 million gigajoules of energy and you can sell 80% of that, rather when most people are only selling 30% of it through existing technologies, you're onto a winner. You've got to sell those gigajoules as outputs at the highest possible price, higher than anybody else, and you've got to do the whole thing within a low carbon footprint. And if you do that, you will be able to outpace everybody else because you can crash gate fees, because you'll be making more money than they will with less efficient systems at lower selling values at the back end of your technology. And that's exactly why I'm so keen on Waste2Tricity, if it works. Big, big issue. But as I say, we'll know more about that by the end of the year. And as I say, we've had a limited time span here, but if you want to know any more, or if anything I've said arouses your interest, then grab me afterwards. Thank you.